Trump tariffs, stock market crashing and debt increasing and everything turning red that you look at. There's a lot of panic. Most people panic in a crash, but it's times like these that create enormous opportunity if you know what you're doing. So I'm going to show you how wealthy people get even richer, and I'm going to show you 6 things that you need to understand to make you a bulletproof wealth magnet in times like these. And then I'm going to give you an actual example of analyzing an opportunity right now so that you can practice this stuff for yourself. And if you apply what you learn here today, this could be life-changing for you. So look, when the markets crash, most people freeze, they panic, they sell, and they wait for some magical green light to tell them that it's safe to start buying again. But the truth is, crashes don't destroy wealth. They just transfer it from people who are unprepared to people who are prepared, you now. And before I show you how to actually analyze an amazing opportunity, I want to go through with you 6 things you need to know. The first one is liquidity equals opportunity. Opportunity is useless without liquidity. And I say this all the time, and it's never been more relevant than this crash now. So if you've been following my content, you've got a cash buffer, you've structured your income, so you've optimized your personal finances so that when the market crashes, you're not reacting. Your position. You've got cash on the sidelines ready to deploy whilst everyone else is scrambling and running around. You're shopping. And whilst most people are forced to sell low and lose money, you're ready to buy low. Step 2 is to view the crash as a clearance sale. Here's how wealthy investors see it, right? Crashes are sales, but instead of 50% off of your trainers, it's 50% off of world-class businesses. You've got strong companies, profitable, scalable, and they're all trading at fire sale prices. Why? Because emotion, fear, headlines, Trump. But with tools like Forecaster and some of the things I'm going to show you in a minute, we can ignore the noise. We can identify true value. And when we do that, we buy what's undervalued, not what's just trending. In March 2020, Amazon, Apple, the S&P 500, they were all on sale, to name a few. Apple went from just under $81.85 per share to $53 per share in just 30 days. And then it skyrocketed. So those who bought the dip instead of sold everything because they were scared made a lot of money. And those who sold lost money. So prices of great companies and indexes get irrationally cheap in crashes like this. So those who bought the dip instead of sold everything because they were scared made a lot of money. And those who sold lost money. So prices of great companies and indexes get irrationally cheap in a crash, and you can identify these if you know what to focus on. Things like strong balance sheets, things like profitable companies, things like sectors with long-term relevance, and I'm going to go over that shortly. Step 3 is to stick to the process. Use dollar cost averaging, value averaging, and advanced dollar cost averaging. Now, having said what I just said, the goal isn't to actually time the bottom. That's not how professionals operate. Timing the market can be a great opportunity once in a decade, like the time we're in right now, but the most effective way to build wealth in the stock market is to use advanced dollar cost averaging. That means when prices drop, we increase our position size, not because we're gambling, but because we've already done the work. We know what it's worth, and the market just gave us a gift. So write this down: process over prediction. Benjamin Graham, who was Warren Buffett's mentor, said, you should buy your stocks like groceries, not perfume. So when you buy perfume, you're inconsistent in the type, the time that you buy it. But with groceries, you buy them every week. The same thing every week. So it's best to invest consistently, weekly or monthly, and use averaging to increase the investment when the price drops. This is what I call advanced dollar cost averaging. And if you want a specific video on this strategy, type advanced DCA into the comments, and if I get enough comments, I'll do a full breakdown. And lastly, focus on long-term compound growth, not quick wins. Step 4 is to buy into the emotion. Buy into the emotion curve. If you understand the psychology of the markets, this part is absolutely key. During euphoria, everyone's a genius, right? But during the depression, when the fear hits its peak, that's your moment. Because whilst everyone else is selling emotionally, you're buying logically. You're stepping in when the value is the highest and competition is the lowest. That's how you build wealth, quietly in the shadows of fear. And if you can stay rational, you win while most people lose. Step 5 is to own, don't gamble. So think ownership, not gambling. This is the identity shift that most successful investors make, and they understand that you're not trading stocks. You're buying ownership in companies. Ask yourself, would I want to own this business for the next 10 years? Do I understand the product? Do I use this product myself? Would I want to be part of this business? Do I actually want to be there? Would I be happy to hold my shares of this company for the next 10 years, even if I wasn't going to get a return until then? Does the company have customer loyalty? And if the answer is yes, then price fluctuations don't scare you because you're thinking like an investor, not a speculator. And you're also thinking longer term. And just a side note, people who complain about interest rates and inflation are the same people that get swung around in times like these because they don't think long term. People complain that interest rates are high and they can't afford their third car on the driveway, but they don't mention the fact that they've had it cheap for so long. So if you factor in the average mean growth of inflation into your wealth management, you don't get hurt when the rates start to rise, and you don't do anything stupid when they drop. So thinking longer term is best all round when it comes to building wealth or managing your finances. And step 6 is position yourself for the recovery. This is where most people miss out. They think that the crash is the end of the story, but it's just the beginning because every crash is followed by a recovery. Look at every single stock that you can think of after the pandemic, after Black Monday, after the oil crisis, after the rate hike, the GFC, the dot-com boom, and on and on and on. Following these times was astronomical growth, and people still say, oh, it's too late now. No, the ones who got rich here are the ones who bought when it was hard, and they held it when it got easy. In 2018, the last time Trump was in power, he did the same thing. He basically tried to slow down economic growth to help the rapid rate of interest rates. And everyone called it a trade war on China, but it really wasn't. It was for longer term protection, even if it hurt America slightly in the short term. It was better for the long term. Long-term views give you perspective, and that's really a wise thing to have in times like these, in crashes like these. It's not timing, it's not positioning, and if you think of the overall stock market like human beings, innovation, human evolution, it removes the emotional numbers and the charts that are attached to it. If this chart of the S&P 500 ever goes down continuously, which it will never do, but if it does, we have bigger fish to fry than where to put our money, because it literally means humans are devolving. Or maybe they are right now. I'm just kidding. But you get the point. So let's take a look now, based on everything I've just said, let's take a look at an example on Forecaster and see if we can analyze a stock and find its real value and whether or not it's a great investment opportunity. So some of the sectors that I always think of, a lot of the time when we go into crashes like this, tech seems to be the obvious one, but I avoid tech purely because tech goes overvalued very quickly. And the reason being is everyone puts their money into tech stocks and, they think that's the sure thing and that's where they're safe. So they move all their money from other stocks into tech stocks thinking that's the thing that's going to ride me through. But then it gets to a point where they're overvalued and then everyone sells out because there's panic. And then you kind of see the rollover on tech stocks. So if your money's all in that one sector, you're probably going to have a bit of a difficult time, just because of panic selling. So think about timeless, sustainable sectors. Things like travel and transportation. Things like finance industry. No one's ever going to stop lending money or needing money, right? Think about things like green energy and things that are sustainable for the future that aren't going to go anywhere. Let's just take finances, for instance. So open up Forecaster. If you haven't used this tool, I'll put the link to the thing in the comments, in the top comment and in the description. But this is a phenomenal tool. And in times like this is really going to be the weapon of choice, because this is going to put you at the forefront of opportunity. Now, let me just go to MasterCard. Okay, so we're talking about Trump's tariffs. Things that aren't going to be affected by Trump's tariff. Visa, MasterCard. There's two already, right? So let's go to MasterCard and let's have a look at that. We'll go over to the fundamentals. And I just want to, first of all, actually, let's go to the overview. See, great, right? Net earnings, you can see dividends just increasing year on year on year without fail. Let's go to the fundamentals. So without diving too deep into the, all the numbers, I want to show you some things that might just really stand out and make this an obvious opportunity. But first of all, do you use this yourself? Do you understand the product of MasterCard? Have you used it before? Have you used it historically? Is it a company that has a brand loyalty, customer loyalty, right? Then you can start looking at the quantitative stuff like, well, the net income, right? The net income's growing, the sales are growing every single year. We can see that the average fair value of this stock is 567 and the current price is 485. That means it's almost 17% below the fair value right now. Okay, that's something to bear in mind. You can see that it's got a strong Petrovsky score. Okay, you can see that it's got a very good Ben-Hashem score, which means it's very unlikely to be manipulating its earnings. You can see that the shares outstanding are decreasing, which is great because the shareholders' yield is increasing, meaning they're buying their shares. The internals are buying their shares back of the company, right? Very robust score. We can see that the transaction processing fees make up for the majority of their products, which is great because they've got full control over that, right? Now, and they've done a very good job over the years of managing that. Because I've used MasterCard for, I can't even remember when. All of my bank cards are MasterCard right now. So what we can do now is then look at some oversold conditions. You can see that the market mood meter, panic selling, is about to bottom out, meaning that we're in panic selling mode, right? Now, there is a very famous quote from Warren Buffett where he says, be fearful when others are greedy, but be greedy when others are fearful. Okay, so when everyone's panicking and selling, that's your time. That is your time to be greedy and gobble up as much of this stuff as you can. Okay, now, by the way, I should say none of this is financial advice, and I'm not telling anyone to invest in anything here. I'm just talking you through some of the things that I'm looking at to see the obvious glaring opportunities in some of these, right? So when you learn this stuff, you can then go and apply your skills to pick out and identify opportunities of your own. Now, let's go over to the seasonality, and I'm just going to, let's just go from today, right, up to this nice high point at the end of the year, towards the end of the year in November. Now, I'm also going to bring on the 7-year and the 10-year, right, and we've got lots and lots of data, seasonality data there. But we can see that on average, we're all above 60%, right? 60% over 3 years, 5 years, 7 years, 10-year seasonality has high correlation scores above 55%, right? Which is great. We can also see that the average return would be 9%, 15. We've got about a 15% average across all of these scores here. If we were to invest in this and come out towards the end of mid-November, there's your historical data for you, right? So this is great. This is great information to know. One of the biggest things you can do is get perspective over what's happened historically. It resets your mind. It gets you thinking in terms of, right, what are we doing here? What is likely to happen next? And it keeps you calm going forward. Most investors, most people who dabble with this stuff, they sell out because they panic. They only buy when it's on its way up and they sell when it's on its way down. They lose money. Getting perspective like this is invaluable. And not only that, this tool has done hours and hours and weeks of research for us to tell us the information on a graphical representation here and giving us everything on a dashboard, which would have taken months before. For a seasoned investor, let alone a retail investor. So you've even got an agent here that can tell you, what's happening. The business explained, what's actually going on with the business, what's likely to happen next, what the earnings report outlooks like, what the initiatives in the company are like, what strategic partnerships they're planning. So if you want confidence in an investment, there's really no better way to look at it. You could take it a step further. Now, I don't, just to show you this is all the crashes, right? So this here was 2018 when Trump last did the slowdown of economic growth. Now he's done the tariffs, right? It's the same thing, but look at the growth on this each time. Now, if you really wanted to take it a step further, you could then go out and pull on MasterCard. I don't recommend you put your trading hat on when you're looking at investments, but look at this, untouchable. This is MasterCard. We're now in a pullback to previous structure resistance if you're looking at it as a trader. But even if you look at all the previous crashes, this is 2018 when Trump done the war on China, trade war on China. This was COVID, right? You go back even further, you can see the GFC, right? But look at this. This is growth. And when you zoom out and you see things from this standpoint, it gives you supreme confidence. And if you've got all of the things that I've been over, liquidity for opportunity, and you're not approaching it like an idiot, you can make life-changing amounts of money doing this. I kid you not. So just to recap, get liquid before the crash. View crashes as a clearance sale. Stick to a proven process. Buy it when others are panicking, right? Think like an owner and ride the recovery. And that's the strategy that has built wealth for decades. There's no one that can argue with me on that. And if you follow it with discipline and structure, you will win. Not by luck, not by hype, because you followed a process over prediction. So if you want help implementing a strategy, check out my free 7-day wealth training in the description of this video. It's a 7-day thing where I send you a video a day by email, and I really, really think that you'll enjoy it and get a lot from it. And with tools like Forecaster and TradingView and the free 7-day training, you really have so much opportunity to make an incredible life from applying the knowledge to the markets and building wealth for you and your family. And when you understand the game, you can play it to win, and you play it to be free. So stay safe, stay structured, and I'll see you in the next one.